Okay, can we start?
Yes, sir.
See, one topic is left out in this module, that is Monetary Policy Committee. So we complete that topic, and then we will also discuss briefly about autonomy of RBI. That discussion which is there related to giving autonomy to RBI, whether it is required or not. We will complete that discussion also, and then we will complete this module. Any doubt you have so far? We have last discussed about Urjit Patel Committee, and before that we have completed our module inflation. So here Monetary Policy Committee. Any doubts? Okay, so you can give a heading Monetary Policy Committee. Monetary Policy Committee, MPC. See, earlier there was a Technical Advisory Committee, TAC, and in this RBI governor will take the final decision. Okay, so this, even though the committee is there, it is a final decision which is actually taken by the RBI governor. But when it comes to MPC, there will be voting in MPC. Okay, so there will be voting, and the committee will decide. So when it was Technical Advisory Committee, when it was TAC, the nature was, it's like advisory only. Okay, so only to advise. So RBI governor will take the decision. Now when it comes to MPC, there is a voting, and based on the voting, the decisions will be taken. So if you see the benefits and all, this is an international best practice, etc. You can write, or okay, just write 2 lines there. Monetary Policy Committee, under that you can write 2 lines. It will provide wider perspective. It will provide wider perspective and diverse views in the formulation of in the process of monetary policy formulation. Diverse views in the process of monetary policy formulation. You will see the members from different areas in this committees. That's why diverse views in the monetary policy formulation. So can someone tell me what are the monetary policy tools? The instruments with RBI related to monetary policy, what are they? Yeah, we have discussed already. There is no need to have any confusion here. CRR, SLR, mainly repo, which is known as the policy rate. Okay, reverse repo. We have also discussed about bank rate. Okay, MSF. All these are part of monetary policy, and these are the monetary policy tools. So policy rate only will be fixed by RBI, and I've told you how reverse repo, bank rate and MSF connected to this, right? So you already know about all these, so I'm not getting into that. That we have done in the previous module, monetary system. So here one more line you write. It will increase transparency and accountability. It will increase transparency and accountability in the process of monetary policy formulation. In the process of monetary policy formulation, because minutes of the meetings are to be disclosed. Minutes of the meetings are to be disclosed. That means in the meetings, who said what, everything has to be recorded, and it has to be disclosed also. Okay, so okay, one more line you write. It will relieve the RBI governor from political pressure. It will relieve the RBI governor from political pressure. One more line you write. It will also reduce the scope of conflict of interest, or the scope of tussle between. It will also reduce the scope of tussle between the RBI governor and the government. This was the main problem. RBI on one side increased the repo during 2013, 14, 15 during Raghuram Rajan's time, and then government keep on increasing the expenditure also. So RBI was not able to control inflation. If you remember, I have told you the monetary policy and the fiscal policy has to go hand in hand to control inflation. So here RBI was adopting a contractionary policy, that means dear money policy, by increasing the policy rate, but government increasing the expenditure and following a expansionary policy. So both was actually contradictory. So that period it was very difficult and there was a issue with government and RBI. So I'm saying in that context. Now write one more line. It will promote coordination between the monetary and fiscal policies. It will promote coordination between the monetary and fiscal policy. When we discuss about the composition of the committee, you will understand, because government also have representative here. Okay, and that representative also have some role to play. So obviously it will promote coordination between the monetary and fiscal policy. So there will be a representative from the finance ministry. Okay, now you can write the composition of MPC. Composition of MPC. 6 members. 1 RBI governor. He is the head. Okay. Then next one, deputy governor of RBI. Who is in charge of monetary policy? There are 4 deputy governors. Actually, there are 4 deputy governors, and in that one, who is in charge of monetary policy. So you can write the deputy governor of RBI who is in charge of monetary policy. Third one, an officer of RBI. That is usually director rank, officer of RBI. So anyone preparing here for RBI? All of you are civil services, or RBI is also there? Okay, you're for RBI. So an officer of RBI, usually director rank. Okay, now right, 3 more members will be there, no? So rest of the 3 members, right? Rest of the 3 members to be appointed by a search cum selection committee. Headed by cabinet secretary. So basically they will be the experts in economics. Okay, so a search cum selection committee will be appointing rest of the 3 members, and they are appointed for a period of 4 years. So and what about voting? Each of these members have 1 vote. So decisions have to be taken on the basis of majority. Okay. Now one point here is RBI governor here have. So what do you mean by majority here? When there are 6 members, it is 4 out of 6, right? This is the majority. 4, 5, 6, that is the majority. What about this situation, 3 and 3, if it is coming? What if this situation is coming, 3 and 3? Then there is a casting or veto. Which one?
Veto, I think. Yeah. By RBI gone.
Veto or casting, or both are same. What do you understand by this? Veto or casting?
So tiebreakers are generally broken by casting vote.
Yeah, it is actually casting vote. It is not veto. In case of, if it is veto, even this 3-3 is not required. Even if all the 5 members are against, governor can go with his decision if he is having veto. Okay, but he have to, upon his writing, and he have to explain the reason why he went for it. So that is the speciality of veto. So here actually no veto. In fact, there was one recommendation with respect to the formulation of this committee, and one recommendation suggested to give veto to RBI governor. But that is the reason why I am specifically mentioning no veto. Okay, there is a casting vote for the governor. So casting vote means in case of equality, governor can say something. If you remember the Pitt's India Act and all, when we have discussed, I have told this point. The Governor General, when we discussed about history, the Governor General will have a casting vote. Same as the case here, casting vote, no veto. Okay. So one more line you write, the minutes of the meetings to be disclosed after 14 days. So once the meeting is done, after 14 days, the minutes of the meetings to be disclosed. So the minutes of the meetings to be disclosed after 14 days. Minutes of the meeting to be disclosed after 14 days. One more point, government can convey its view to MPC in writing. Government can convey its views to MPC in writing. MPC means Monetary Policy Committee. MPC in writing. Now there were two recommendations. Urjit Patel Committee also talked about MPC. So we will see what Urjit Patel Committee said with respect to this Monetary Policy Committee. So what he said is there should be 5 members. Just for your knowledge, I am explaining this. There should be 5 members and all from RBI. All the 5 members should be from RBI. So the distribution is like this: 3 directly from RBI, like what you can see here. Already 3 are directly from RBI. No, the first 3 are directly from RBI. RBI Governor, Deputy Governor in charge of monetary policy, and Officer of RBI. And then rest of the 2 will be appointed by RBI. The 2 appointed by RBI. So this is what proposed by Urjit Patel, and he said no veto to RBI. No veto to RBI. Okay. Then there is one more recommendation, that is FSLRC. FSLRC. What is FSLRC? Financial Sector Legislative Reform Commission. You can write Financial Sector Legislative Reform Commission. So what they said is 7 members and 4 from RBI, 4 from RBI and 3 from government. Okay. So, and there should be a 1 non-voting nominee from the government. 1 non-voting nominee from the government. That means government actually can send a secretary to attend the meeting. Government can send a secretary to attend the meeting. Now here they proposed a veto power to RBI governor. Okay. So other things are same. This veto power is actually given with written explanation because you are going against the majority. So there should be a written explanation for that. So these are the recommendations with respect to Monetary Policy Committee. Not at all important for prelims, but I have just told you what you need to know is this one. This one is what you need to know. You need to know it is a casting vote and voting pattern decisions. Now one more important aspect is all these are important from your mains point of view. You need to write these things. Okay, the agreement also, Monetary Policy Framework Agreement between Government of India and RBI. So Monetary Policy Framework Agreement, Monetary Policy Framework Agreement between Government of India and RBI. So just write few lines there. It was signed in Feb 2015. It was signed in Feb 2015 and was included in RBI Act 1934 and was included in RBI Act 1934 in 2016. RBI Act 1934, it was included in 2016. The features, you can write the features. The prime objective of monetary policy, the prime objective of monetary policy is to maintain price stability, while keeping in mind the objective of growth. To maintain the price stability while keeping in mind the objective of growth. So you might be knowing that one term that I have used, inflation targeting along with keeping in mind the growth aspect. What was that word we have discussed yesterday, last day? flexible inflation targeting. Okay, so in bracket you can write flexible inflation targeting. That means inflation is your priority, but at the same time you have to keep in mind the growth also. Okay. Next point you write, government in consultation with the RBI. Government in consultation with the RBI will fix the inflation target once in every 5 years. Inflation target once in every 5 years. Accordingly, the government has notified the target rate of inflation, the target rate of which inflation, which one we use now, WPI or CPI?
CPI.
We use CPI now, okay? So you write there, accordingly the government has notified the target rate of CPI based inflation at 4% plus or minus 2 percentage point. I've told you the difference between percentage and percentage point. So percentage point means it can be directly, you can say 2 minus from 4, that is 2, and 2 plus from 4, that is 6. So 2 to 6 you can write if it is percentage point. Percentage point means 100 basis point. So if in case if I am saying 4% plus or minus 2%, then it is entirely different. So what you need to see is 2% of 4 you need to find, right? What is that? 2% of 4, that is 0.08, right? 0.08. So you will be writing it as 3.92 to 4.08. Not this. We are not talking about percentage. We are talking about percentage point. Okay. 4% plus or minus 2 percentage point from August 2016 to March 2021. So March 2021 till this is the inflation targeting. So every 5 year it will change. So 2016 to March 2021. Okay. Next point. The RBI has to publish. RBI has to publish the monetary policy report after every 6 months. The monetary policy report after every 6 months, comma, indicating sources of inflation, and forecast of inflation. Forecast means in bracket you can write 18 months. So there will be 18-month forecast. Okay. So what will be the range in the next 18 months? So RBI have to show the sources of inflation and the forecast of inflation. Next point you write, the RBI will be deemed to fail in achieving the inflation target. The RBI will be deemed to fail in achieving the inflation target if inflation remain below 2% or above 6%. So if it is, what is the range? Range is 2 to 6. So if it goes below 2% and if it is above 6%, RBI is deemed to fail in achieving the inflation target, comma, for 3 consecutive quarters. So in 3 consecutive quarters, if this is happening, RBI is deemed to fail in achieving the inflation target. Now in case of failure, what to do? Just write one more line. In case of failure to achieve the inflation target, the RBI has to submit a report. To the central government indicating A, the first one, reasons for failure to achieve the target. Why? Reasons for failure to achieve the target. B, the measures proposed by the RBI to achieve the target. Measures. So you have to tell the reasons to central government in the report. You have to also tell the measures that you're going to take or proposed in the achievement of target. 3 a time frame within which the target is expected to be achieved. Time frame within which the target is expected to be achieved pursuant to such measures. So by what time you can achieve this? So see, what I'm saying is, as per the agreement, the inflation targeting, it is actually fixed. It should be 2 to 6, right? So 4 plus or minus 2 percentage point. So that should be 2 to 6. In case if it is going below 2 and if it is going above 6 for 3 consecutive quarters, RBI is deemed to be failed in achieving the inflation target. In that context, RBI have to give a letter to the central government by indicating why the inflation, what are the reasons, okay, what are the measures that is going to be proposed, and by what time you can achieve this. So you can see here the entire responsibility is actually with the RBI. Okay, but government also have to play a role in controlling inflation. But here you can see the entire burden, entire responsibility of controlling inflation is actually here given to the RBI, and this is one of the major drawback of this. Okay. Now, what about cost push inflation? Can RBI have any role here in case of cost push inflation? Can RBI do anything? RBI cannot do anything because it is related to supply. If at all something to be done, it has to be done by the government. Okay, so actually government is more effective than RBI in controlling inflation, but you can see here entire burden is actually, entire responsibilities with the RBI. Okay, now just write one line over there, inflation targeting. So that's about MPC, that framework agreement between Government of India and RBI. Okay, so now you can write inflation targeting. Inflation targeting. So this was actually a prelims question, this concept before. Under this policy, central bank give priority to inflation control. Priority to inflation control over other objectives of monetary policy. Can someone tell me what are the other objectives of monetary policy? For what else we use monetary policy? We have discussed it. Which one? Growth, and then?
Price control.
No, that is what inflation. Price control. Huh?
Appreciation or depreciation?
Yeah, depreciation of rupee, right? Depreciation of rupee. So basically, if you control inflation, depreciation of rupee problem will automatically be solved. No? Yes or no? Both of these two are connected or not?
Yes, sir, we tried them out.
Both are connected because both are caused because of what? Depreciation of rupee is because of what? What is a common thread in inflation and depreciation of rupee?
So trade?
No. Money supply. You just tell me in that way. So if money supply is high, inflation will be there and depreciation will be there. Why still confusion? If this is how we have discussed, no? So let's suppose this is national income. First case inflation we will discuss. This is price level and this is the aggregate demand. This is the aggregate supply. So when money supply increase, what will happen? The aggregate demand increase. So you can see here there is an increase in price. So this is inflation, right? This diagram shows inflation. Why this happened? It is because of money supply is high. Because of money supply increase, what happened? Aggregate demand was high, so the price level went high. The prices went high. Okay, so this is inflation. Second, you can see connected to this one. What? Depreciation of rupee. You can draw here same like here the quantity of dollar demanded and supplied. Here we will go for price of dollar in terms of rupee, right? So let's say this is the demand for dollar and this is the supply of dollar. So let's say this is a normal situation, equilibrium point, and let's say 65 rupees is the price of $1. Now money, the same reason, money supply increased, that's because of that inflation. Same money supply increased, the purchasing power increased, right? That's why aggregate demand increased. So the same will happen here also. Money supply increase, purchasing power increase, so demand for dollar also will increase. This aggregate demand include dollar also. So demand for dollar increase, so demand curve shift rightward. You can see here the price of dollar is increasing. That becomes 75. So here when the price is increasing, this is what we call as depreciation of rupee. So this is depreciation of rupee. So what RBI will do? What RBI will do here? For both, to achieve these two, if you need to control the inflation and depreciation, what you need to control? Money supply you need to control. So you have to decrease money supply. When you decrease money supply, the purchasing power will come down. When this come down, aggregate demand will come down. So when the aggregate demand come down, I can show you here. Okay, so in the first one, in the first diagram, demand curve shift leftward, right? So you can see here the prices have come down. So when money supply reduced, inflation coming down. Secondly, in the second diagram, if you look, when money supply decrease, again demand for dollar will come down, so demand curve also shift leftward. So the rupee appreciate. Let's say this becomes 60. So this is what we call as rupee appreciation. I hope this is clear. Okay, so to do this, there are not only, and also to promote growth, also RBI do the same thing, no? So you can use monetary policy to promote the growth also. That's what I mean by this. Priority is inflation control over and above growth and depreciation. Okay, where we were writing this under inflation targeting, no?
Yes, sir.
Is this point is clear? Any doubt here? This graphs are clear. This one, this is, if you understood this, then it's okay. Any problem in interpreting or understanding this graphs for you that I am drawing? Are we okay with the graphs? Because some of you might have missed the demand supply session. They may face some difficulty, otherwise it's okay. Okay. Because the application of these are coming a lot in the coming sessions. Everywhere in economy I use these graphs only to explain the concepts. Okay, next you give a heading advantages. Advantages. We were talking about that monetary policy framework agreement. Okay, advantages. It increases accountability of central bank. First one, it increases accountability of central bank. Accountability of central bank, as it clearly defines objectives of monetary policy. As it clearly defines objectivity of monetary policy. Objective of monetary policy. What is the objective of monetary policy?
Control inflation.
Flexible inflation targeting. Okay, so next point you write, it increases sensitivity of the government and central bank towards inflation control. It increases sensitivity of the government and central bank towards inflation control. Third one, it reduces scope of tussle between, that you have already written. Now disadvantages you write, the problems, disadvantages. The main problem is what we have already discussed. The entire responsibility is actually given to the central bank, but government should have taken some more proactive measures, especially in case of cost push inflation. It is supply side and government have to put effort. RBI can only control the demand pull inflation, and which is caused due to money supply, because the tools that RBI have, the monetary policy tools, can only control the demand pull inflation. So write that monetary policy is not much effective. Monetary policy is not much effective in controlling cost push inflation. In controlling cost push inflation in such a case, contractionary policy significantly affect the growth. Okay, so this is how it is actually going to happen. So let's suppose national income and price level. When you go for the normal situation, aggregate demand, aggregate supply. So if this is a position, now when inflation is there, or this is a high price, okay, so let's say this is high price. So even if RBI do something to control the demand, so RBI may achieve in controlling the demand somewhat like this. Okay, so RBI will control the demand, so demand has come down, but what will happen? Don't you think it will affect supply? Will it affect supply or not?
Yes, sir.
So it will affect supply drastically. So it will affect supply, and you can see here, this is the new point, right? The two new curves are meeting. So prices are further increasing because supply is actually coming down, and more importantly, you can see here, the growth is coming down. Now secondly, even if you are not taking into consideration the supply part, just by decreasing the demand, I'll show you one more diagram. National income and price level, this is aggregate demand, this is aggregate supply. So if this is a normal situation, just by decreasing the demand, you can see here demand decreased. So this is a new point now. So price may be coming down, but growth significantly affected. Okay, so price may come down, not sure, because we are only talking about demand influence. But when the demand decreases, automatically supply will be affected. So this picture will represent it in a broad way. You might have some reduction in demand, that's what I am showing through the this blue one, and more reduction in supply you will see, that is what I have shown through red one. So the new equilibrium will actually increase the price, and it will affect the growth also. Okay, this is a disadvantage.
Excuse me, sir.
Yes.
Also, in the advantages of framework, you said that it increases sensitivity of government. Sir, kindly explain this.
No, sensitivity of government means government also have to do something. Like government also have to apply the contractionary fiscal policy. It is not.
It is like we read constitution in unitary method and federal method. So in the same way, we can use this framework because it is clearly written in this that RBI is responsible to control this inflation.
RBI have to the government also have to complement RBI in controlling inflation.
Government should do in consultation with RBI.
And RBI should do in consultation with government. Because when we talk about RBI is passed through an act. Okay. So government, the power of government is coming from constitution. So even government can amend the constitution, and RBI act can also be amended. Government can appoint the governor of RBI. So in all these ways, government is more powerful, and government will fix the objective. So if this objective is fixed, that is 4 plus or minus 2, this is in consultation with both government and RBI only. So once it is a framework agreement between Government of India and RBI. So what I am saying is, because of this agreement, even government is also sensitive now. Earlier that was not the case. When RBI keep on increasing the repo, government keep on increasing the expenditure. But now it is a responsibility of both. Actually, RBI is is a part of government only. We cannot see both are separate.
Yes, sir. Yes.
Yeah. So now that is what you don't want to worry about those kind of sentences. When we are writing advantages, we write whatever we feel like. When we write the disadvantages, in the same way we will criticize also. So don't, because these questions can be asked in main, so you need to have some points. No, that's why these are ready-made points.
Okay, sir.
Yeah.
Okay, sir.
Excuse me, sir.
Yeah, tell me, Dilip.
Sir, how in diagram first simultaneously aggregate demand and supply decreases simultaneously?
No, demand decreased. Why? Here I am talking about R-based. Imagine this situation: the price is high. Let's say this is high price. Okay, so this inflation is there. So what is the RBI objective? Inflation targeting. So RBI have to reduce the price. So to reduce the price, RBI have to do what? Reduce the money supply, because demand will come down. So that is what this blue curve. So what RBI action taken is RBI reduced the money supply. So when money supply reduced, this happened. Is that okay? Blue curve, demand decreased.
Okay.
Yeah. Now when the demand decreased, there are two things. One, in market demand is not there. So you are not able to sell your products. So the firms stop producing. That is one thing. Secondly, demand is decreased by reducing money supply. To reduce money supply, what RBI did? RBI actually increased the interest. So the firms now cannot borrow money at a lower interest rate. So what will happen? Investment will come down. So investment will come down plus demand will come down. So supply will automatically come down, because nobody is there to buy your product. People don't have money. Demand is not there. So what will happen? Supply will also come down, and that is what I have shifted both to the left side. Is that clear?
Yes, sir.
Okay, so in this diagram, when I am talking about this diagram, I have not talked anything from supply side. That's why when demand is decreased, price is decreased, that is okay. But here demand is decreased, there is a possibility that price can increase. So what I am saying is, what is the conclusion? It is not only by controlling demand you cannot control inflation. For especially in developing countries, the main problem is supply. Developed countries, the situation won't be there. Why? Because there is no problem with supply there. In developing countries, the main problem is with supply and infrastructure and investment. Developed countries, the situation is not a big problem. In developed countries, they only keep on promoting demand. And in that context, if you remember, we have discussed about quantitative easing, etc. in the previous module. Towards the end, when we discussed about monetary policy, developed countries will go for quantitative easing, etc. to promote the demand. So this is actually a specific problem in developing countries, the cost push inflation or the supply side inflation. Okay. Okay.
Excuse me, sir.
Yeah, tell me.
Sir, your voice is trailing off.
Oh, you're not able to listen to me.
No, sir, it is trailing off in between.
Even now also?
Sir, I mean, I can listen to you, but not completely. Like the voice is trailing off in between.
Okay, I don't know. So all of you are facing the same problem?
Yes, sir. Yes, sir.
Okay, 1 second. Okay, we were okay till this discussion, or you were not able to listen in between also? Shivangi, the problem happened now or before? Before also, you were able to
Before. Sorry?
You were able to understand all those things that I have discussed?
Sir, the distortions are still there.
Okay, I don't know, the problem was with the internet, so okay, I just adjust for two more days and I will manage it in 2-3 days, okay?
Sure, sir.
Yeah. So just write one more line there. It is not supposed to be desirable for developing countries. It is not supposed to be desirable for developing countries because
So what is not supposed to be desirable?
this inflation targeting, the monetary policy measures.
Okay.
it is not supposed to be desirable for developing countries because in such countries inflation is usually caused due to cost push or supply side factors. Cost push or supply side factors. Okay, so if you remember, we are not going for complete inflation targeting. We have already talked about flexible inflation targeting. That means we are looking for growth also. Okay, now are you able to hear, or the same problem is there?
No, sir, it is perfectly clear.
Okay, so we are not completely focusing on inflation targeting now. It is flexible inflation targeting. Okay, so flexible inflation targeting, that means growth is also taken into consideration. So we have not accepted that inflation targeting as such, flexible inflation targeting. Now developed countries, this problem will not be there because their productive capacity is so high. So UK and all, I have told you before, they target 2% inflation, right? So for them it is fine, and beyond this it is going to be very difficult for them because their productive capacity is so high. But in India we should not be less than 2%. If it is less than 2%, it is deemed to be, RBI deemed to be failed in achieving the target. But that is not the case with developed countries. Okay, now you give another heading, autonomy of RBI. Autonomy of RBI. Now what is the present situation? Is it is it having complete autonomy or semi-autonomous? You can write now semi-autonomous. Semi-autonomous. Okay, why? Because the major for any major action you have to consult government. So in that context we can say semi-autonomous only. So the ultimate authority is what? Ultimate authority is government only. Okay, because government is drawing the authority from where? Government is getting the authority from the constitution, as I have told you before. So RBI is actually established under RBI Act 1934, right? So RBI established under RBI Act. Government is getting the authority from the constitution, and you see this RBI Act can be amended by the government, and RBI governor is also appointed by the government. So in all these ways the main authority is whom? It is the ultimate authority is actually the government. Now you can write few sentences in favor of giving autonomy. So you can write arguments in favor of autonomy. Arguments in favor of autonomy. That's the main question. Okay, so write few lines. Arguments in favor of autonomy. Enhance the accountability of central bank. Enhance the accountability of central bank. Second, it will ensure formulation of monetary policy. It will ensure formulation of monetary policy on professional basis. On professional basis, that is, it will be isolated or insulated from political constraints. It will be.
Sir, sorry, sir. Can you please repeat this point from the beginning, sir?
It will ensure formulation of monetary policy on professional basis. That is, it will be insulated from political constraints. Okay, one more line. Next point. It will restrain government from taking advantage of. It will restrain government from taking the advantage of the short-term trade-off between inflation and economic growth due to political compulsion. Due to political compulsion. It will restrain government from taking advantage of the short-term trade-off between inflation and economic growth due to political compulsion. I've already discussed this. Because of political compulsion, government may have to spend more. Government have to increase the expenditure, especially during the times of election and all. Government have to increase the expenditure, and that will go against, the inflation targeting. Okay, now you can write arguments against autonomy. Arguments against autonomy. It will weaken the coordination between monetary and fiscal policy. It will weaken the coordination between monetary and fiscal policy. Second, you can write the central bank lacks, or central bank will not be accountable to the public. Central bank will not be accountable to the public. Okay, one more point. When you discuss about autonomy, you can say the aspect of autonomy. It can be in two aspects of autonomy. This discussion is basically on the basis of objective autonomy or objective. What is the objective? Okay, and then instruments. That means in case of use of various instruments. So objectives autonomy and instruments autonomy. So this is objectives. Okay, so what are the instruments? Instruments means CRR, SLR, etc. So what you can say is, we have already discussed arguments in favor and arguments against. So what should be the conclusion is, government should fix the objective. Okay, to meet the objective, RBI should be given what autonomy? This autonomy, instrument autonomy should be given. So that should be a conclusion that you can write, and you can write it in your own words. So when we discuss about autonomy, there is no need to give complete autonomy to RBI. There is no need to completely separate RBI from the government. Both should work together. And in fact, the objectives of the monetary policy or the policies of the RBI should be fixed by the government. Like if it is inflation targeting, government should fix it. If it is to promote growth, government should fix that. And then RBI use its instruments in its own way. So in this application of the instruments, you should be giving autonomy to RBI. So that way you can close this discussion. Is that clear? Okay, any doubts? So that's how you can conclude the discussion. So objective, it should be by the government, and the way you use the instruments to achieve the objective, that in that case you should be giving autonomy. Okay, so we are done with this module. Next, I think we will start with banking, slightly lengthy module, very lengthy module, and you will get questions also from that. A lot of questions. You can get 3-4 questions from banking. Banking or capital market, any one of this will start. Can we stop here?
Okay.
Okay, sir.
Yeah, bye.
Okay, sir. Bye.